All right, it is now time for Chapter 3, where we learn how to adjust accounts at the end of the period. So let's take a look at what we're going to see in Chapter 3. Here are the objectives. We're going to be looking at why we have reporting and what the adjustments need to be. We do have a ratio that we're going to do called the profit margin ratio at the end of the chapter. We're going to learn how to do some adjusting entries, so new types of journal entries that we do to adjust accounts at the end of the period. So let's get started with our first one. All right, when we're looking at the accounting period, we've talked about this before, so this part's not new. We're looking at making sure that we're dividing things in periods of times, and we talked about that when we talked about the time period concept. So here we see that we can divide into quarters, so 3 months at a time. We can divide it into months. We have semi-annual and annual. So the time period assumption assumes that we're going to divide those into specific time periods. So these are the examples of the time periods. Typically, organizations use a year as their primary accounting period, but we're also going to have interim financial statements where we might break it down into 1 month, 3 months, or a quarter, 6 months, semi-annual, just to kind of see how we're doing as we go. All right. So that part again, just explaining more of the time period assumption, not getting into too much depth with that one. Our next one, when we're looking at this, we have the two different types of accounting bases that we can use. The first is called the accrual basis, which is what we're going to be using. The second is called the cash basis. So when we look at the accrual basis, it's telling us that revenues are going to be recognized when they're earned, and expenses are going to be recognized when they're incurred. Well, this follows along with that revenue recognition principle, right? And also with a matching principle. So we have to make sure that we're following those accounting rules. The accrual basis follows those rules. The cash basis says that we're going to recognize revenues when we receive the cash, and we're going to recognize expenses when we pay it. Well, according to our GAAP rules, we can't do that. So we're only going to see using accrual to follow GAAP requirements. Here's an example. So it shows us on the accrual basis, $100 of insurance expense is recognized in 2019, $1,200 in 2020, and $1,100 in 2021. So that comes from them paying insurance up front. So you can see up here that we paid $2,400 for 24 months of insurance beginning December 1st. So December 1st, we had insurance that we paid for, but we paid for 24 months up front. Well, remember we had that prepaid account? So we will be using that for that $2,400, right? But we get to the end of December and now we've used 1 month of it. So we're going to recognize 1 month of expense for that. So if we had $2,400 that we paid 24 months, we divide that and it's $100 per month that we would recognize for insurance expense as we've used it. So we had 1 month of use in December, so we're going to use $100 in 2019. When we go into 2020, remember we paid for 24 months. So we have all 12 months of 2020. So that is $1,200. And that leaves us with 11 months left that we prepaid. So we're going to expense each month in 2021, and that's going to have a total of $1,100. So the expenses match with the periods that we actually had the insurance coverage to make sure that we're following those GAAP rules. So that's the accrual basis. Let's look at how the cash basis would look at it. So the cash basis, same scenario, we paid $2,400 for 24 months that began December 1st. So under the cash basis, they would recognize all $2,400 as an expense in 2019. And they would have no insurance expense in 2020 or 2021. So what that does is it inflates our expenses in 2019 and it makes our net income lower. But in 2020 and 21, then our expenses are lower, so our net income is inflated. So we don't want either to be inflated. We want it to be our actual expenses. So that's why we're going to be using that accrual method. All right, so just a couple things we're going to review. Recognizing revenues. Remember, the revenue recognition principle requires that revenue is going to be recorded when the goods or services are provided to the customer and at the amount that's expected to be received from customers. So what we actually charge them. So the accrual basis accounting, we recognize the revenue when it's earned. It's not earned until we've provided that good or service to the customer. All right, when we're recognizing expenses, remember the expense recognition or the matching principle tells us that our expenses need to be recorded in the same accounting period as the revenues that are earned that were related to those expenses. So for example, if we're running a business, we have sales for the month. Those sales were based off of, us operating out of a building. If we had electric expense for that month, that's related to the sales for that month. So we want to record the electric expense in that month when we recognize the sales, when we use the building for that sale. All right. So in Chapter 3, what we're going to be doing is we're going to be looking at adjusting entries. We're going to use what we call a 3-step process to make sure that we can get to the ending balance that we should. So there are 4 types of adjustments that we're going to be looking at. When we're talking about adjusting entries, they're something that they're made at the end of the accounting period, and it's to reflect a transaction or event that has not yet been recorded. So it's helpful to group adjustments by the timing of cash receipts or cash payments in relation to the recognition of their expenses or revenue. So here's a framework of how we're going to be doing this. So there are 2 broad categories of adjustments. The first is when we pay or receive cash before the expense or revenue is recognized. And this category includes prepaid or deferred expenses, including depreciation and unearned or deferred revenues. The second major category is going to be when we have adjustments when cash is paid or received after the expense or revenue is recognized. So these are pretty common adjustments, and they can include what we call accrued expenses or accrued revenues. So we're going to be looking at those, and we're doing this, we're going to use 3 steps. So first we're going to figure out what is the balance at that point in time. So what is the current account balance in that account? And then we are going to determine what should it be? What do we want it to be? And then we are going to do an adjusting entry based on that. Now, a couple things to point out. First, every adjusting entry affects 1 or more income statement accounts and 1 or more balance sheet accounts. The other thing is we never ever adjust the cash account. So you never have to think, what account am I going to use here if it's an adjusting entry? It's never going to be cash. All right, so let's get into the first type of adjusting entries. So these are called deferred expenses or prepaid expenses. So they are assets that we paid for in advance of receiving their benefits. When they're used, they become expenses. So we talked about this a little bit. You can see here the examples they give us: prepaid insurance, prepaid rent, and we also see supplies. So we talked before about up until now, we have just been buying supplies and putting it in a closet to use at some point in the future. When we've used them at the end of the period, we're going to do this adjustment. So we see here that we have an adjustment we're going to do. For all adjustments involving prepaid expenses, we increase or debit an expense account and reduce or credit an asset account. Just remember, it's never going to be the cash account. So we can see here that for prepaid deferred expenses, our entry is always going to be a debit to some expense account and a credit to some asset account. So that's one tip. One thing to remember also is you have handouts in the Chapter 3 Resources tab. Make sure you go back and review them because they will have some tips or quick references for these. Okay, so let's look at this one. So our first one, we have a balance. Okay, so it says that we have Fast Forward paid $2,400 to cover insurance for 24 months that began December 1st, 2019. We recorded the expenditures prepaid insurance on December 1st, right? Because we paid it up front. So we paid $2,400 up front, so we debited prepaid insurance and we credited cash because we paid it out. So our balance currently in prepaid insurance is $2,400. So that's our first step. Our second step, we need to look at, it says step 2, balance in the prepaid account should equal $2,300. Well, where do we get that from? All right, well, if it was $2,400 total divided by 24 months, down here we see the calculation, then it's $100 per month, right? So that means we have to expense $100 of it, and that would leave we want prepaid to be $100 less. So we want prepaid to have a balance of $2,300 after this transaction. So to do that, we're going to remember, it says for adjusting prepaids, you're debiting an expense account and you're crediting an asset account. So the example here, we are debiting insurance expense and we are crediting prepaid insurance. It's going to bring that prepaid insurance to be reduced $100 down to a balance of $2,300. So this is what we see here. We have an adjustment now. We have a balance in prepaid insurance of $2,300. There's 23 months of prepaid insurance remaining. We've now debited insurance expense, and our insurance expense has increased by $100. So typically when you see insurance, just so you can kind of get some of the terminology, they're going to say expired or unexpired. So when you hear that, expired means that's how much we have used. Unexpired is how much is left. So if it tells you that you have $2,300 of unexpired insurance, that means you have $2,300 that you have not used yet. If they told you that you had $100 that has expired, then that's when you're going to adjust the account by $100. All right, so here's what the actual entry would look like. So it has the journal adjustment for December 31st, and it's debiting insurance expense for $100, and it's crediting prepaid insurance for $100. So that is our first adjusting entry, and that is going to adjust the amount of insurance we have actually used now. So at the end of December 31st, we have used 1 month of insurance. And we're going to show that as an expense and reduce the prepaid with that. All right, let's look at an example with supplies. So this tells us that we purchased $9,720 of supplies in December. We used some of them in December also. So at the end of the month, we went into our supply closet. We did a physical count to see what we have left. And it says the physical count shows that we had unused supplies that were $8,670. So going into this, our balance was $97.20, right? We purchased that in December. We had supplies on hand of $97.20. But now we've done a count at the end of the month, and we see that we have some that we've used. So we need to adjust it for that. All right. So we're going to be adjusting the entry. We're adjusting it for the amount that we've used. So if we started with $9,720 and we ended up with $8,670, if we subtract the difference, we get a difference of $1,050. So our supplies are going to be reduced by supplies on hand. So the supplies in our closet, we've used $1,050 of it. So we're going to make sure that we adjust our account by that. So we're going to, again, it's a debit, it's an adjusting entry for a prepaid. Supplies falls under that. We bought it up front, right? So we're debiting an expense account and we're crediting an asset account. This time we're debiting supplies expense and we're crediting supplies. So we're reducing the supplies that we show on hand, and we're expensing what we've used, because now we've used $1,050 of it. So here we can see the entry. We've debited supplies expense and we've credited supplies. Now if you look in our supplies account up here, we have a balance of $8,670 going into the next month. As we use more the next month, we'll expense more at the end of next month. We'll do the physical count at the end of the month to see what we have left and then go forward from there. All right, this is the end of the first section for our lecture videos. We will continue with the next section in part 2.